Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Today I'm joined by Todd McGarity, the Portfolio Strategist at Polaris, because I'd like to discuss a few of the emerging themes that we're seeing as we enter the second month of 2013. Certainly we're seeing some contra-indicators economically and politically. We're still staring down the barrel of a somewhat frustrating debt situation that does not seem to be reaching any kind of a solution. So, you know, it's interesting as we're looking at all of these political factors and somewhat, questionable economic factors, we're still seeing a market that is rallying into 2013 to the tune of 6 to 7% as we enter the month of February, and it's somewhat surprising that that's what's happening. So, I'm sort of curious what your opinion is on why that's happening. What are some of the fundamentals driving that when you look at the political situation that we still have on hand?
Well, I think, as you know, it's the best January we've had since 1994, which caught a lot of people off guard given the fiscal cliff issues going into the end of last year. And really what's more surprising to me is we really didn't get anything done on the fiscal cliff.
In fact, if anything, the market, was expecting that we weren't going to get anything done.
Yeah.
There was all this concern of, are we going to go over the cliff? And I know on previous shows I've discussed, with previous guests, the fact that we were concerned that we were just going to fall off a cliff. The market's going to decline 50%.
Right.
Where are we going to go?
Well,
and that didn't happen. It didn't even come close to happening.
Right. I think what the market's telling you is it has confidence that is going to get done either through some sort of agreement between parties or some sort of compromise, or that the bond market itself is going to dictate some fiscal policy.
And I want to talk about that here in just a second, but what do you think are some of the drivers as we look at this 6 to 7% surge? What is driving that? I mean, we've spoken in the past about strong balance sheets, money on the sidelines, but what are investors looking at as to, now is the time to move in? What are you seeing?
Well, I think we're finally starting to see the beginnings of multiple expansion, which we really haven't had. If you look at the market over the last...
Okay, discuss that for a second here.
Okay.
Multiple expansion, meaning we're talking about PE multiples or price to earnings multiples.
Exactly. As you know, the market itself, from an equity standpoint, really hasn't done anything for quite a while, over 10 years.
We've had compressed multiples.
That's right. I mean, you're getting companies, especially after the 07 crash there. We've had companies doing, a lot of things to get leaner, reducing headcount, which obviously has sent unemployment, to a painful level. But during this time, they've gotten, leaner and meaner, and their balance sheets are tighter. And now we're starting to see the first signs of growth. And I think the market is telling you, looking 6 months to a year out, they're starting to see some economic expansion and finally some turn in the economy. And I think at that point, you're going to see some multiple expansion on a lot of multiples.
To talk through that for just a second, so as the companies get leaner, balance sheets get better, and earnings start to increase, obviously the net earnings are also increasing. So when we're talking about price to earnings multiples, when we say that earnings are increasing, we're now going to finally see that prices for stocks are going to go up because that multiple of earnings or multiple times earnings to arrive at price is what we're seeing.
Absolutely, and not only multiple expansion for because of economic reasons, but also that they've been overly compressed. There's been a big fear about equities, in the last 3 to 4 years. You've seen it with all sorts of macroeconomic issues in Europe, our fiscal problems here. So you can see that there's been a massive run on treasuries and safety type securities.
And yet at the same time, while we've had concern about equities, you saw the Dow and the S&P both up anywhere from 10 to 13% last year, depending on which index you're looking at. But that was driven almost entirely by large cap, high dividend yielding companies because interest rates are so low.
Well, you had such a scramble for yield, right? I mean, you had the Fed that really kept down the Treasury market with this quantitative easing programs, and they kept rates artificially low.
So don't fight the Fed. There was plenty of money still running into the equity markets and
Exactly.
the high dividend yielding type
I think
names.
they achieved what they were trying to achieve, which is try to get people to invest more in risk assets, which means equities.
So, one question that I have when it comes to that and sort of getting into some of our initial themes here is, can the large cap, high dividend yielding stocks, the blue chips, can they still expand? Are you still seeing the margin expansion on those type names, or are we now going to see companies down the line, smaller in the food chain? Are we going to see them start to rear up?
Well, I think it does start to filter down, through all asset classes. But I think what we've seen in this first run, which has been a little bit more promising than these past head fakes that we've had over the last couple of years, and actually in January's. We've seen the first 3 months of the year look promising, only to
to have
roll
everybody
over.
start to at least stick a toe in, maybe an
Exactly.
entire foot, and then realize that.
But what we've seen run this time are the older line big cap industrials. We've had industrials
Such as?
participate. Gosh, I mean, if you take all the Dow 30, we've seen the Dow 30 stocks really start to make a move. We've also seen tech participate this time, old line tech that we haven't seen in the past. You've got Microsoft, for instance, today that is starting to make moves on the upside. So that stock has been flat for a while. You're also seeing, the old financials, old line financials starting to break to new highs here, which they haven't seen since the '07 crash.
Right. Actually, let's take it in that direction here for a second. That's another theme that I know we've been talking about for a few years now. And I don't want to harp on interest rates because we've talked about it over and over again, so the viewers of the show have heard us discussing that. But as we've said before, interest rates have to go up at some point, whether it's driven by positive motivations such as an economic rebound or negative motivators such as a debt downgrade.
Right.
Either way, interest rates are going to have to go up. We're starting to see that happen. What is going to be the impact of that interest rate increase, whether it's quick or slow? What's going to be the impact on banks and why?
Well, I think there's no doubt we've seen a bottoming in long-term rates for sure, and we're starting to see the Treasury market sell off a little bit. So we're seeing longer term, really not only longer term, but 10-year maturities up to 30-year maturities starting to show signs of.
The 10-year actually crossed 2%, I think, for the first time in.
It did for the first time in a long time, for several years. So even if we go back to a somewhat of a low end of normal from where the Fed really squeezed rates down artificially by this quantitative easing program. If gosh, I think it was just a couple of years ago, several years ago, we were looking at a 10-year at 4%,
which seemed low,
which
at
seemed
that time.
really low, and wondering if we could ever go below that point. Much less the 30-year. It's when you see a 30-year below 3%, that's really, you could say at that point that the Fed was really artificially keeping rates down. So we can, to answer your question, I think we can see a pretty significant increase in rates just to get to the low end of what the normal range is.
And the impact of that on banks, of course, is if there's going to be an increased spread, that they're able to benefit from. They're a lot leaner now than they were before, unfortunately, as we have increased unemployment as a result of that, or one of the factors anyway.
Right.
But they're a lot leaner, they're a lot better capitalized, their reserves are a lot stronger than they have been in the past. So with all of those factors, and then you add on to that the fact that we should start to see an increased spread that they will then benefit from.
Well, that's why we like financials so much, is anytime you have an increasing rates from the low end, especially as artificially low as they have been, really that net interest margin that banks make on deposits versus loans, and you see increasing economic activity, so there's going to be more loans. You're getting kind of towards the end of this housing, I guess the mortgage loan nightmare.
Right, the numbers
a lot
are
of them
starting to
made
look a lot
settlements
better.
with Fannie Mae and all, and all the government organizations. So I think at this point, the earnings power for banks going forward, based on an increasing, what we call an increasing yield curve or steepening yield curve, is pretty promising. I think we're not only on the front of a strong bank move this year, but I think we're looking at a multi-year expansion in
I think
the
it would be
financials.
short-sighted, though, to ignore the regulatory issues that we have on hand and what the impact of that could be.
It is, but a lot of them have made adjustments, and if you look at when the implementation is, I mean, a lot of that is still up in the air as to what.
And they're used to being regulated anyway.
Absolutely.
It's not like banking has lacked regulation, depending on what your perspective is, I guess.
And it's really not going to be a short-term implementation. It's going to be long-term. They've got a
Phasing
lot
in.
of time to adapt to that, and really prop trading was or proprietary trading that banks made a lot of money on non-traditionally.
Was really one of the
earnings drivers in the past,
Right.
but that's going to change. A lot of them have shut down prop trading desk, and that's already happened. So I think what you're going to see is these big financials and big money center banks start to make money the old-fashioned way, and that's loans. So I think the banking business is going to return to a little more of a traditional format, but with the yield curve steepening and economic activity increasing the way it is, headcounts at the lowest they've been in a long time, reserves like we were talking about it's such strong rates. I think banks are healthier than they've been in a long time. So I think we're on the front of a multi-year expansion in the financials.
It'd be nice to see that happen because we know what follows. So let's take a quick break, actually, if you don't mind.
Okay.
We'll be right back to continue with these themes for 2013. Thanks for joining us. We'll be right back with Money Matters. Welcome back to Money Matters. We're joined today by Todd McGarity, portfolio strategist at Polaris, and we're discussing major themes that we're seeing in the market in 2013 as we enter February of 2013, and we're seeing a big surge in equities. So one thing that we've been talking about largely for the last year and a half is interest rates. We covered that in the first part of the show again today because it really is having a big impact on our market. But an area of interest rates or the impact of interest rates that we haven't discussed is high yield. And high yield bonds tend to be a higher interest rate because they tend to be a perceived higher risk or lower rated bond. And talk to me a little bit about how an increase in interest rates, could impact high yield and sort of what the trends have been in high yield over the past year that we, might see either continuing or reversing.
All right, you and I have talked about this, that the level between, or the rates of governments right now, the spread between those and the rates on high yield are historically low levels.
Because so much money has been seeking yield and therefore, rolling into high yield, thus bringing the...
Yeah, you've seen really a massive scramble for yield, and in this search for yield, it's really driven down the yield, or the prices have really been, driven up in
because of the
higher
demand
yielding
for
assets.
yield.
Right. So, I think during a scenario of increasing rates, which what we're seeing now is a little bit of a steepening of the yield curve, and we think that's going to continue, obviously, with improved economic activity. That higher yield that people have scrambled for might be a little overpriced here, so that might not be the place to be going forward with increasing rates.
Right, so we have that sort of perceived risk here of, it's not just the yield that people are seeking, it's usually total return that investors are seeking. So if you start to see a flight away from bonds towards equities, especially equities that have 3, 4, 5% dividends, if you start to see a flight away from those bonds towards equities, then you'll see the prices fall, and therefore the total return of those bonds will fall. I mean, so it's a pendulum swinging.
Exactly, and whenever you see rates at historically low levels, what you can bank on is that will start to return back to a normal pricing based on the risk associated with that yield.
So in a nutshell, high yield bonds will probably be affected the same way as, say, treasuries and any other type of bond as we start to see interest rates rise, because there will be a flight away from those, and those spreads will start to widen.
That's exactly right.
So one opportunity there might be perhaps even shorting a high yield index or something along those lines. Or
that is, I think what we I personally, prefer shorting the Treasury market because I think that is where the Fed has, obviously intervened and has kept rates to a ridiculously low level. We've seen a 30-year below 3, we've seen a 10-year below 2. I think it hit 160. That's by anybody's measure. I don't think that anybody perceived that we would ever get there. So I think that's where it offers the least risk with the most return is shorting that Treasury market. And we've been short for this past year. We were a little bit early, and I think we're now starting to. But I think we're now starting to get paid off for that in a big way. You can see that rates.
Rallies.
It doesn't take much of a rate increase, like we talked about in an earlier segment. It doesn't take much of a rate increase to really pile on the returns there with very little risk.
And it'll be interesting to see, how long it takes that pendulum to start to swing. But that when it does, it's going to have a lot of momentum behind it.
Well, and you hear this talk, on the financial news networks. You hear a lot of talk about this bond bubble, and that is what the, I think what the risk is out there is this bond bubble. And because of all that talk, once you see rates start to creep up this way, and you start to see improving, employment, improving economic numbers, which we're starting to see. And the wind down of this quantitative easing that the Fed has participated in, return to the housing market, all these things right now are really, tailwinds. And once you start to see some sell-off in that bond market, I think you're going to see a pretty good scramble for the door there. So,
one other area of the bond market that we don't touch on all that much, and I think you and I probably have slightly differing opinions on it, is the municipal bond market.
Right.
There's still an argument, regardless of what's happening with interest rates and the fear of price erosion, et cetera, there's still a need for a perceived less risky asset. And yes, there's definitely more perceived risk in bonds today than there has been in many years past, perhaps in the last decade.
Sure.
But I still feel that there is a need in a lot of cases for short-term, extremely short-term bonds in some portfolios, depending on the risk profile of the clients that you're talking to. And I do feel that short-term municipals still have a place in a lot of portfolios, largely because of what's gone on with the tax situation.
Absolutely. I think anytime you have increasing tax rates on the on the high end, you're going to get an interest toward munis. And I mean,
well, and I should probably clarify, municipal bonds have special tax treatment in that the coupons are not taxed. They're not taxed, and if it's a state that you live in, it's also the state does not tax it as well. So it's significantly more beneficial. The income is significantly more beneficial than other bond income.
Another thing we hadn't really talked about is the the increased debt loads that a lot of these municipalities, because of the lower tax revenue, lower property tax, all the way to income tax. The take has been less, so a lot of these budgets have swelled to record levels. They're carrying a lot of debt, and there's going to be a lot of need for for issuance going forward.
I totally agree. In fact, what's going on with healthcare and Obamacare is also, a lot of that is being pushed to the states, and that is probably also going to cause a lot of budget issues, budget tightening, et cetera. So that's one area that I think we might not see quite as much price erosion there, especially at the very short end of the curve, and probably a lot of new issues, as you discussed, because you have those conflicting, you have movements in interest rates, but you also have the tax situation. So that's an area that might still be, have somewhat of a safety net if it's something that fits for.
And like you said, given the environment, I would definitely stay at the short end of the curve, short maturities on those to give you less exposure. A good, a laddered type portfolio at that point definitely makes sense, going forward with rising rates. So.
Laddered portfolio meaning maturities at different points throughout the yield curve. Yeah. So those are some areas that I think we continue to look at: municipals, high yield, and watching that pendulum swing. What are some other areas though? Because there's still, I don't know which metric we want to use, whether it's 4 trillion or whatever number it is. There's still a lot of cash sitting on the sidelines. People that haven't yet really wanted to dive back into equity markets. They feel like we're, here we are at the top of the, Dow at 1,400, sort of banging our head up against 14,000, I'm sorry. And banging our head up against it. You feel that we're actually about to surge right through. Why do you feel that? And, you've talked before about chasing the market and people just racing to get into it at the last minute.
Well, if you look at the S&P, which is a large measure, not just the Dow, but if you look at the S&P, which encompasses 500 stocks, if you look at that index, we're starting to see, like we talked about in the first segment, we're starting to see breakouts of old line industrials, things that didn't participate in these last few head fakes. Not only that, we're just now, from a technical standpoint, breaking out on the S&P. So this is kind of has the feeling of a rally nobody trusted, at least in January, because of the issues fiscally.
Because, you're a technical analyst of sorts, so when you talk about breaking out, we're basically breaking through that last area of resistance.
Exactly.
But how do you then assess what the next stopping point is at that point? I mean, how do you not feel that you're just getting in here at the top and we're about to bump back down?
Well, I think it's obviously looking at levels of resistance, and support. Once you break up through resistance, that initially becomes the initial resistance now becomes support on a pullback. So it's easy to measure that line at that point of saying, hey, if the market does pull back in here, it should hold the support. If it doesn't, then you can make a buy or sell decision based on that. So that's why so many people follow that. It's really a matter of measuring overhead supply.
Okay.
In the market. So once we push through that overhead supply, which we just have broken out some significant resistance levels. I think I think at that point that's why this market is rallying with everybody not really trusting it. It's common that so-called wall of worry.
Wall of worry.
So.
But it does seem that we're on sort of the front end of what typically is about a 6-year cyclical, run in the markets. That's typically the way it works, is about a 6-year historical cycle. You'd say that we're somewhat delayed coming into that 6 years, so I don't know how much of a run we still have left, but it does certainly have the feeling of being
absolutely
on the front end of that.
Well, given what we've come out of too, right? I mean, with the housing market, as bad as it was, and like I said, that's why we like financials so much going forward. It's all the baggage that they've had that they have slowly moved through and gotten rid of. I think with a steepening yield curve, I think that is really going to be one of the hot sectors for the next 5 years or so.
So basically, in summary, while we're not pounding the table saying buy, buy, buy with our buy button, it certainly is now worth, regardless of the fact that we are sort of sitting at the top of the Dow, it's definitely worth taking a look at your portfolio and perhaps, diving a little bit more into equities, perhaps looking at some of those other value plays that perhaps you've been avoiding, and,
Absolutely, and with
so that you don't find yourself chasing
and
that
what the market's
performance
telling you is it's seeing better times, better economy on the horizon there. So hopefully if we can get through these fiscal issues in Washington, we get the housing market coming back a little bit and employment numbers, getting a little bit better, steepening yield curve, rates moving up to, we've got some room for rates to move up where, before it hits really, before it starts, pulling money out of equities. So we've got quite a ways to go before that. So
hopefully it'll be fun to watch this pendulum swing.
Yeah, absolutely.
Thank you very much for joining us today.
Sure.
I really appreciate it, and I hope
Enjoyed
that you'll
being here.
join us back again here and have some more positive commentary at that time. So, and thank you for joining us. We always appreciate it. Please keep sending us your ideas for shows. Send us your questions. That always makes for great TV. And please check us out on Facebook. Send us any emails, comments that you might have. We love to hear from you. So thanks for joining us again today. This is Money Matters. I'm Emily Johnson. See you next week.